The crypto market didn't just crash on November 2nd, 2021. It evaporated, incinerating trillions in value overnight. While you watched cartoon apes trade for the price of a suburban home, the foundation of the digital economy was quietly rotting. Now that the speculative mania has finally receded, we are left staring at the wreckage. It is time to determine if this digital gold rush was a foundation for the future or simply a graveyard. Different landscape than the one promised in those television commercials. There is a third, deeper layer to this story that goes beyond the speculative bubbles, a part that is actually functioning right now while you are watching this, and we will get to that at the end. So grab a drink, settle in, and let us strip away the noise. First, let us look at the reality of the virtual world. Remember when everyone was convinced that we would all be spending our workdays inside headsets, meeting avatars in digital offices? Facebook rebranded to Meta on October 28, 2021, pouring billions into the vision. But look at the numbers. Decentraland, one of the leading platforms, reported monthly active user counts that barely cracked the thousands, despite valuations that hit several $billion at the peak of the hype cycle. It turns out that most people do not want to attend board meetings in a low resolution digital room while wearing a heavy piece of plastic on their face. The friction of the technology remains the ultimate gatekeeper. Yet, the concept did not just disappear into the ether. Instead, the focus shifted from consumer social platforms to industrial digital twins. Take the automotive industry as an example. Companies like BMW are using Omniverse technology to simulate entire factories in real time before building a single physical wall. They test assembly line efficiency, ergonomics, and robot coordination in a digital replica that is accurate down to the millimeter. This is not about cartoon avatars buying virtual land. It is about saving millions in manufacturing costs by predicting failures before they happen. That is an easy win for technology adoption. It works because it solves a business problem rather than manufacturing a social one. Now, let us move to the more complex and often more painful world of cryptocurrency. You remember the summer of 2021. Everyone you knew was talking about decentralized finance and yields that seemed too good to be true. And as it turns out, they were. The collapse of the Terra Luna ecosystem on May 7th, 2022, wiped out roughly $40 billion in market value in just a few days. People lost life savings in the blink of an eye. That was the level up. It was a brutal lesson in the difference between decentralization and unregulated leverage. People finally started asking the questions they should have asked at the start. Where is the yield coming from? Is this a sustainable protocol or just a sophisticated math trick? Following that crash, the market went through what some call the long winter. Total market capitalization dropped from nearly $3 trillion to under $1 trillion. But look at what survived. The protocols that did not rely on unsustainable reward schemes, like those providing actual decentralized lending services, kept ticking. The infrastructure remained. Developers did not leave. They just stopped chasing the speculative pump and dump schemes and started working on layer 2 solutions meant to fix the fundamental bottleneck of high transaction fees. It is a maturation process. The tourists left and the architects stayed to build the plumbing. If you are finding this breakdown helpful, consider hitting subscribe. I dive into these shifts every single week to keep you ahead of the curve. All right, now for the part I've been holding for you. This is the piece that most people miss because they are too busy looking at price charts or meme coins. It is the transition to real-world asset tokenization. This is the third most critical shift. We are currently seeing major financial institutions, think BlackRock and Fidelity, beginning to move traditional financial instruments like United States Treasury bills and private credit funds onto public blockchain ledgers. Think about what that actually means. Right now, moving $1 million across international borders or settling a private asset sale can take days, involve a dozen middlemen, and cost a small fortune in administrative fees. By tokenizing these assets, you reduce the settlement time from 3 days to near instantaneous. You remove the manual reconciliation process. A report from the Boston Consulting Group estimated that the tokenization of global illiquid assets could reach $16 trillion by the year 2030. Let that sink in. We are not talking about magic internet money or digital plots of land that nobody visits. We are talking about the actual underlying infrastructure of the global financial system being upgraded to operate on a 24/7 programmable basis. This is the hidden backbone that has been growing in the background while the media focused on the celebrity-endorsed scams and the vaporware. The technology that was hyped for its potential to replace traditional banking is actually being adopted by the banks themselves to make their own operations faster and more profitable. It is the ultimate irony of the entire movement. The rebels did not burn the system down. They handed it a new tool that it is now using to become even more efficient. So, where does that leave you? It means the hype was a distraction, but the underlying innovations were real all along. The metaverse did not replace the physical world, but it revolutionized industrial design. Crypto hype did not create a new utopia, but it exposed the fragility of unchecked leverage and forced a reckoning that cleaned up the space and the tokenization of assets. That is quietly turning into the biggest transformation in finance since the invention of the ATM. You now see the pattern. The noise is almost always the wrong place to look if you want to understand where the world is heading. Pay attention to the boring, structural upgrades. Pay attention to what the big institutions are quietly deploying in their back offices while the public is busy arguing over the latest social media trend. That is where the real value is being created, and that is where the smart money is actually going. You are now equipped with a completely different perspective than you had when you started this video. You can see past the glossy marketing of digital worlds and the speculative frenzy of tokens. You are looking at the infrastructure, the real world utility, and the inevitable institutional integration. That is the shift that matters. And once you start seeing the world this way, it is hard to go back to caring about the next big hype cycle. If this gave you a clearer lens to view the future, share it with someone who is still caught up in the noise. Subscribe to stay in the loop and stick around because I have another deep dive coming next week that will change the way you look at your own personal investments. Thanks for spending this time with me. It was a pleasure, and I will see you in the next one.